Welcome back. I'm visiting here today with Richard Schwartz. He's one of the pioneers in crowdfunding and also an advisor to the Gates Foundation and Rockefeller Foundation. And appreciate you being on today's show, Richard.
Glad to be here, Alan. Thank you.
So, American Dreams, we talk about the pathways of life and how individuals came to where they are today. And for the listeners, can you give us your background and what brought you up to even the concept of bringing crowdfunding into this market?
I'm happy to. It's sort of a long story. I'll make it really short for your audience. I'm a former professor, and I used to teach information science, and I got really bored being a professor. I left and started a startup and had an exit event, so I sort of hit a home run on my first try, and I did it the second time and didn't quite succeed as well as I did the first time. But I got really passionate about trying to help other entrepreneurs once I'd had some success. And I created a meetup, and that meetup became the fastest growing meetup in America for business owners. And through that, I started talking to hundreds and thousands of other entrepreneurs and realized there was this crazy bill in Congress that was going to allow entrepreneurs to raise money directly through the internet, sort of overturning 80 years of securities laws. So I showed up in Washington, D.C. and said, I want to help.
And so when you started out with going before Congress, and obviously there had to be some resistance with investment banks, the SEC standards, moving into this. How did you work around all this?
Well, I can't take credit for the Jobs Act. Actually, there's a few people, Jason Best, Woody Neese, Zach Dorian, Ruth Hedges. There's about 4 or 5 people that really carried the flag. I showed up right when the Congress was thinking about it. But at the time, I was also advising a multi-billionaire who was putting a huge amount of money into entrepreneurship education. And you show up in D.C. saying, I work for a billionaire, and people suddenly become your friend. So I spent a lot of time helping sort of organize the industry, moving meetings with the SEC, meetings with Congress, meetings with the White House, meetings with key influential folks. In fact, the White House sent me on a roadshow and asked me to go interview investors all across the U.S. to find out what their reactions were to crowdfunding. And you're right, Alan, there was tons of resistance. In fact, today we still have a lot of resistance because the idea of empowering entrepreneurs to raise funds directly, even though there is a platform, but still the idea of taking out what has traditionally been the role of a broker-dealer is really threatening to the established sort of financial model. And there's a lot of resistance, and it'll probably take years for us to fight our way through all of it.
You know, in today's market, we have the investment bankers had a clear role, but we've transitioned into, I think, and we're still in the middle of this transitional paradigm shift of how do companies exit. But I'd like to roll back to dealing with the millennials. Do you find the millennials more quickly gravitate towards the concept of crowdfunding?
Absolutely, millennials are all over this. The average person doing it is probably just a little bit older than a millennial, but there's tens of thousands of millennials that have been successful using crowdfunding through Kickstarter and Indiegogo, and they're just now starting to think about how they can actually raise equity. It actually is perfectly calibrated to the DNA of a millennial. Social-based, about community, about following your passion, about supporting people who are trying to make a difference, about supporting entrepreneurship, and you can think about it as sort of the millennial answer to investment banking.
You know, when a person is in their crowdfunding, are there any standards that they should be setting in terms of who do they let into the company versus not?
Well, there's a couple of things. The equity crowdfunding is actually highly regulated because you are offering a security, and I won't bore your audience with all the laws, but you will have to meet with an attorney, and you are going to have to make sure you keep yourselves compliant. In terms of who you want as an investor in your company, that is a little bit out of your control because once you make a public offer of the security, you can't say, I like Alan, but I don't like Mary, so Mary can't buy. So any qualified person can purchase that security once you offer it on these platforms, which becomes part of the challenge. The good news is you can set your own terms. You can create the term sheet. Unlike going to a venture capitalist where they dictate the terms to you if they take their money, you can dictate the terms to your audience. I'm willing to offer stock under these conditions. So the power shifts back to the entrepreneur in terms of setting the terms and the cap table and what type of stock you're offering, or you can even do debt. You don't have to do stock, do crowdfunding. But once that offer is posted, you can't control who buys.
I'm visiting here today with Richard Schwartz. He's one of the pioneers in crowdfunding. Richard, I need to take a quick break, and we'll be right back after these messages.
I love fishing, with my family. I think it would be easier to use a net.
It was so much fun.
The times when we are together, it makes it all the more worth it.
Having Dad teach them how to cast a fly rod, and
as long as we're doing stuff together, we're having fun.
Some people see a father and a son fishing together, while others see a succession plan. Welcome back. I'm visiting here today with Richard Schwartz. He's a pioneer in crowdfunding. And Richard, I want to step back for our audience, and there's different types of crowdfunding. Can you tell me what they are?
I'd be happy to. First one is what everybody thinks about, Kickstarter, Indiegogo. It's you're offering a product or you're asking for a donation. There's no security involved. It's been around for about 8-9 years, doing exceptionally well. Hundreds of thousands of entrepreneurs have taken advantage of it. Equity crowdfunding or investment crowdfunding is relatively new. There's 3 pieces. I won't bore your audience with all the legalities, but one form allows you to raise money only from wealthy individuals, basically the angel investors or venture capitalists, but now through an online platform. And that has been here since 2013, and over $10 billion has been raised in the U.S. through that already. No cap on what you can raise. You can raise theoretically any amount of money you can get investors to give you. Then Title IV is also called Reg A+, which is also called a mini IPO, and it's just as confusing as it sounds. But what it means is you can raise up to $50 million through equity crowdfunding. Now, obviously, the SEC wants to take a look at that, and they actually have to approve the issuance, but it's like a really lightweight, easy way of going public. So we call it the mini IPO. 30 years ago, companies could go into the public markets when they had $10 or $20 million. Nowadays, you have to be a billion-dollar company to even think of being listed on the stock exchange. So it's almost like rolling back the clock to how it used to be. Like Home Depot went public with 4 stores, but that can't happen anymore. You can also do what's called regulation crowdfunding, which is also called Title III, that allows you to raise up to $1 million a year, and you can raise that from anybody, accredited investors, which mean the wealthy, or an average citizen. This is brand new, only went live May 16th of 2016. So there's not a lot of track record yet. There's a lot of excitement about the ability of a small entrepreneur located anywhere in America to raise money, whether that's a local small business or whether that's actually a startup.
So Richard, when we're looking at companies today that say, I want to go out and crowdfund, what advice do you have for them?
First question is, do you actually need the money? Too many people think they need to go get investment dollars. Sometimes they need to just figure out how to be more lean. Maybe you just need to sell more product. You don't always need the money, so it's sort of counterintuitive, but make sure you actually do need to raise funds. Secondly, do you just need money or do you need smart money? Meaning, do you need advice? Do you need mentorship? Do you need board members? Or do you just need capital? If you need the mentoring and the assistance, probably look for angel networks. All the traditional models work really well for many companies. But there are some situations where people have tried and just cannot raise funds through traditional channels. Crowdfunding sometimes is a better option for them. And the way I'm describing it makes crowdfunding sound like it's for the lemons, and it's not. There's some companies that choose to do crowdfunding. So here's a couple reasons why. One is, it's not just about the money. It's about the crowd, about building your network, about getting your message out there, about getting product evangelists, and also it's a great marketing and PR strategy. So some really smart entrepreneurs think about crowdfunding not just financially, but as sort of like the ultimate example of lean startup. You get product, market, fit, support, interns knocking on your door, and investor interest all in one process. You do have to think about, do you actually have a crowd? One of the myths of crowdfunding is that there's these huge legions of investors just waiting to give you money if you go on a crowdfunding platform. Crowdfunding platform handles the transactions, the legality, the compliance, the stock certificates, all the messy details of crowdfunding, but they don't have tens of thousands of investors knocking at their door wanting to give your company money. So you still have to have a network, whether that's Facebook, Twitter, LinkedIn, whether you throw a rave, whether you have an event launch, whether you're connected to your alumni association, whether you're part of the vegan food truck club. I mean, whatever it is you're into, you have to have a circle of affinity, or you have to have a crowd to follow you onto the platform. You bring the crowd, they bring the compliance to keep you legal. Then you have to think about, how much money do you actually need? Is $500,000 going to be enough? If you're a tech startup, your runway might be $2, $3, $5 million. So you have to really make sure that you understand how much cash you need over what period of time to be successful. And based on those requirements, you pick the right model. Then once you know what you need to raise, you then pick a platform. Some platforms are essentially Craigslist. They just list, and they don't do much for you. Other platforms are actually run by broker-dealers. So they have networks of investors, and they will pick up the phone call, and they will try to sell your security. Obviously, the broker-dealers take a higher commission. You're talking roughly 7 to 9% of the amount of money you raise goes to commissions. Then you also have to know how to market very effectively. Most entrepreneurs that spend a lot of time developing their product are horrible marketers. So you need to find an agency who can help you with the very specific details of internet-based marketing, social media marketing. It's essentially an integrated multi-channel marketing campaign that has as its net result raising investment dollars. And unfortunately, there's only a very small number of agencies out there that actually know how to do this.
So Richard, I need to take a quick break. I'm visiting today with Richard Schwartz. He's one of the pioneers in crowdfunding, and we'll be right back after these messages. Since you can't take your wealth with you, spend time with your family. Welcome back, and visiting here today with Richard Schwartz. He is a pioneer in crowdfunding, and in the past segments we were talking about the different types of crowdfunding, and you're currently involved in a new company called NextGen Crowdfunding.
Yes, thanks, Jim.
Can we walk through this this business model of really what is it that NextGen is focused in on and the vision for the future?
Yeah, happy to. And actually, NextGen was founded by a guy named Aubrey Chernick, who started a computer program writing code at his wife's desk and got acquired by IBM, so literally a self-made tech founder. And his passion is helping people understand the significance of what these new crowdfunding rules really mean for the ability of entrepreneurs to get financed. And his story is, no one would have backed me. No venture capitalist would have believed in me. No one would have believed that some first-time entrepreneur could beat IBM, although he did. So his personal passion is, how do we educate and inform the 250 million Americans that could take advantage of crowdfunding about this new opportunity? Because most people have no idea what it is. So he brought me on as his chief of strategy to help figure out how we get the message out, essentially, how we educate and inform and allow investors to discover these opportunities. We're not actually a platform ourselves. We don't provide transactions. We don't finance companies. Think of us as Kayak meets an educational service. We try to help people understand what this new world means.
Yeah, as we focus in on the future and the new world, where do you see things heading?
Social investing. Why shouldn't you be able to use information exchange inside of Twitter or Facebook? I mean, for the dawn of human history, when people have had a creative idea, you turn to your family or your synagogue or your tribe or your fraternity or whatever network you were part of, and you raised money from people that cared about you and cared about what you were doing. Crowdfunding just allows that to happen using technology. But we already have seen the major effect of equity crowdfunding has been that angel networks are cooperating now. Angel networks are syndicating. What that means is, you used to go to one angel network and try to get them to write you a big fat check. Even if they say yes, what they now do is they tap into lots of other networks. So everyone's syndicating, everyone's spreading risk and spreading opportunities. And so it's basically based on openness, data sharing, transparency, and social networks, which should really make a lot of sense to your millennial audience. And that's one reason it's growing so fast. So where the future is a lot of investing is going to be socially based, and you're going to want to know what other people have to say about an investment opportunity, not just trust your broker if you actually have a broker, or read the 400-page prospectus, which is required by the government that nobody has time to read anyway. So why not turn to your crowd to help you make intelligent investment decisions?
Are there any restrictions on charitable dollars coming through crowdfunding?
In terms of charitable dollars, it's a whole other discussion. In terms of donations, like GoFundMe is the best-known charity website. Anyone can donate, but that's actually considered revenue, so there's a lot of tax consequences around crowdfunding. And some people think crowdfunding money is free. Well, the IRS doesn't think so. They do tax you on it.
Yeah, that's interesting. Why do you think that is? Should it be free?
I don't think it should be free. It's just a different mechanism for raising funds. Now, if you're a 501c3 and you can structure a donation, why not? Now, some really creative not-for-profits have done a crowdfunding campaign with a very small amount of money they're trying to raise. What they're really trying to do is get the millennials to talk to their parents and grandparents to get them excited about what they're doing, so they will then write the big checks in the old-fashioned way. But most 65-year-old people don't put money through platforms. They still want to meet and greet, shake hands, talk to folks before they write checks. So crowdfunding for the millennials sometimes is a way to get the millennials to talk to the old folks.
So how does a person find out more information on NextGen?
It's nextgencrowdfunding.com. If you want to find out about our platform, want to find out how to reach me, it's just richard@richardswart.com, SWART.
And what advice would you have for investors in terms of if they're coming to you, Richard, should I consider this? Or, how would you pitch whether or not a person should be involved in crowdfunding?
As an investor?
Yes.
I actually do a lot of advising work with investment groups and family offices to answer that exact question. The answer is it's a type of alternative assets, essentially a private equity security. And what you should do is you should take a small portfolio, a small portion of your portfolio, and you should spread your investment across 10 or 20 or 30 startups. Imagine being able to get into a startup for $500 or $1,000 instead of having to write the $25,000 or the $50,000 check. So if you have a tolerance for risk and you like early stage companies, invest in 20 or 30 or 50 companies a year rather than trying to pick the one that has a high chance of succeeding.
There's the last question here. Exit strategies in today's market seem to be more challenged. Any advice for a person going into crowdfunding and getting out?
Well, if you're offering what's called a Title III security, regulation crowdfunding, those are basically buy and hold securities. There's almost no liquidity in those markets right now. If you're using the $50 million raises, you have to list on OTC or NASDAQ, so there's liquidity the very first day. So different types of crowdfunding have different types of liquidity options available to investors and entrepreneurs. What we've seen some very creative entrepreneurs do is get money from an angel network and then use Regulation A crowdfunding as an early liquidity event to get some cash back in the hands of the investors and cash back in the hands of the founders. So crowdfunding can play well with angel investing. It's a sort of a complicated relationship, but it is actually a new option for liquidity.
I've been visiting here today with Richard Schwartz. He is one of the pioneers in crowdfunding and also involved with NextGen Crowdfunding. Richard, we're out of time today, but I appreciate you being on today's show.
It's been a pleasure. Thanks, Alan.
We'll be right back after these messages.